Hi there, how are you? Welcome back to M Talks. We are continuing with Money Works. In the previous sessions, we saw how it all began money, and then we saw a bit of banking, what banks mean to an economy, what banks mean to us. Now, banks have to all the time balance between risk and growth. So they have to be careful with the market dynamics and work alongside to make sure that both these factors are always taken care of. Earlier, when banks started operating aggressively in the market, they looked at the larger or the corporate clients as the key target or the key segment because they always felt that putting large sums in smaller pockets was easier to manage in terms of risk and infrastructure. But the thing is, these large clients were fewer in number, and over a period of time, banks started running out of clients. So they had to look elsewhere. They started looking at retail. If you look at 10 years back, they shifted focus to retail. Retail meaning individual clients like you and I. And then they realized the risk was better if they put less money in a larger number of pockets. Even though managing it meant higher, larger infrastructure, they realized that risk was much easier that way, managed that way. Talking of risk, risks has always been there as part of human lives. We have been aware of danger and risk consciously or subconsciously, and we have been preparing ourselves for this consciously or subconsciously, which is why I think the humankind is the more dominant and the more resilient species. If you look at it, it started from the very early days when it was not a conscious act. But people, when they went hunting and gathering for food, they went in groups. Even though it meant that the spoils have to be shared, they didn't mind. They still went as groups because they realized it was less riskier and less dangerous as well. However, if we think when risk cover or insurance as a concept came into play, people would look at life insurance or life cover. But no, that's not how it started. As in the case with banking, insurance started as a facilitator or a risk mitigator for traders, for merchants. In fact, there are recorded transactions in a manuscript called the Code of Hammurabi. I don't know if I'm pronouncing it right, but I'm sure nobody is going to complain because Hammurabi is long dead and gone. He was the sixth Babylonian king, and he is supposed to be a damn good law writer. He had written a lot of laws which lasted for long periods of time. Anyhow, so there are transactions which took place then where merchants, when they took funding for a shipload of their goods, they paid the lender some extra premium to write off the loan in case the ships were either lost at sea or drowned. This was the earliest form of risk mitigation. And this practice started and grew across different regions as well. And people started adopting this. But it had a major downside to the lender, obviously, because not only he loses his entire money for a small additional income, but the whole thing becomes one-sided as a transaction. So they were not happy about it. So they needed to balance between funding and risk taking, which is basically peril risk, as in the risk due to voyages, sea, the vagaries at sea, and so on and so forth. And then, as this developed, they had to find a way to separate funding, as in funding for the product, funding for the commodity which the merchant was going to trade in a different location, and the risk factor. reaching the location where the trade has to happen. So they wanted to draw up separate contracts for funding and for risk. So the merchants were not happy in this case. And then the merchants became very smart. What they started doing was they started pooling resources to fund for a shipload, which means like 4 or 5 or 10 merchants pooled their resources in terms of money, in terms of products, everything for a shipload. So, in case there is a loss or the ship went down, the loss is shared amongst these people. That still was much easier for the moneylender because he was lending small sums of money to different individuals or different merchants. So, for him, the risk was lower. So this all started till the British Empire started colonizing more and more. And the empire, for all the royalties and all the good things they got out of the colonies, they had to do something in return. So they started ensuring maritime trade or maritime uh, shipways between different colonies. So there was a clamor amongst merchants to find a solution for this problem, somebody to take care of the bill. In the early days, there was in London, a place called Lloyd's Coffee House, where the merchants, the lenders, and the ship owners, they used to meet. And there they discussed this at length, and there was a set of people who came forward to underwrite the risk. They were called the underwriters. In fact, the term underwriting is still synonymous with Lloyd's. So, what the underwriters did was in a piece of paper, they would write the quantum that they are willing to underwrite per ship. So, this is how underwriting started. And then this became a strong practice. Though those days they didn't have historical data to analyze, and they didn't have statistical methods to analyze risk, and so they went by some basic parameters: the experience of the captain, the seaworthiness of the ship, the safety of the route that they were taking, and all those aspects were considered before the quantum of underwriting was decided by each underwriter. So this became the first form of insurance that happened, or risk mitigation. Do you know, interestingly, the first ever modern life insurance in its early form was issued to a William Gibbons in the year 1536. The underwriters insured his life for £400 for a premium of £36, and for a period of 1 year only, yeah? Only 1 year. But interestingly, that gentleman died before 12 months from the date of this contract. So his family got £400. This was the first case of the modern life insurance. Then in 1666, there was this great London fire. And people saw not just a tragedy, some people saw opportunity as well, as is the case always. So there was a Dr. Nicholas Barden who started the first insurance company issuing, obviously, fire insurance. What he did was he hired his own firefighters, he bought his own firefighting equipment, and the people whose houses were insured with him were given what is called fire badges, which were hung in the gates or the front door or wherever, depending on the house. So in case of fire, the firefighters will take care of this particular household, which was insured with them. So this business started, and a lot of people started coming into this business saying that it's lucrative. Only in case of fire there is work, otherwise money is there. So then imagine there were a lot of these insurance companies hiring their own firefighters and taking care of households insured with them. So it was such a mess. So many firefighters and so many different insurance companies. And finally, it became so much of a confusion that they all came together and decided, okay, fine, we are not going to do this anymore. We will hand this over to the municipality. So this is how fire insurance came about. But today, in the contemporary context, fire insurance is not an independent insurance anymore. It is covered under generic building or property insurance. So then, as insurance in the form of risk cover or risk protection or taking care of these what should I say unforeseen circumstances started, they also saw the opportunity in the flip side, as in if we can look at protecting uncertainty in terms of risk, why can't we look at taking care of uncertainty in terms of growing money or in terms of investment? For example, if there was an opportunity, a business opportunity or an investment opportunity, I'll give you an example. If it was valued at £100, let's say, what they did was they broke it into £1 units and they sold it to individuals. So for an individual, a £1 was easier to put aside as an investment as compared to a £100 investment, which not only can they not manage in terms of funds, but they also didn't have the expertise to understand about these investments, which the insurance company can kind of take care of by hiring people who know these things. So that is how they started investment products. So these investment products were sold more in terms of not savings or not something that can be withdrawn every now and then, but more in terms of creating a fund for, let us say, retirement or fund for a specific purpose to be taken care of after so many number of years. So they started creating these pension funds and they became very popular. Today, modern insurance has become like the banking sector, a critical pillar for an economy because it provides an invaluable support. It covers the risk that an economy otherwise would have a problem with. If the banks support the economy by providing the liquidity, the insurance company provide the safety or the backup for uncertainty for different businesses for different types of risks. So it was absolutely essential for the insurance companies to be supported by the governments as well. Today, a lot of aspects that are important where there is a risk, element of risk or danger involved, we can safely pass this risk on to the insurance companies and go on doing about whatever we have to do to progress in our lives. For example, I mean, life insurance, obviously, in case, God forbid, something untoward were to happen to somebody, then the family or the dependents are to that to a certain extent. I mean, it's in an insurance term, life is infungible, which means irreplaceable. But yes, there is a certain solace when somebody gets some monetary benefit to continue on till they find their own footing in life. And then we on a daily basis, uh, we use the road and we use transportation like cars, motorbikes. Insurance for them protects them in case there is an issue or an accident, again, God forbid. And property insurance and so many different things as well. And most importantly today, a very prevalent insurance or very popular insurance is the medical insurance. Again, this is something which those days was a big problem. I mean, if everything is fine, it's all great, and we are running around doing all our stuff to make money and to move on in our lives, to take care of our people, families, and all that stuff. But something were to happen. This is all something which you really cannot foresee. If you fall sick, expenses those days, medical expenses were like enormous. I mean, it'll write off people's savings completely. Today, thankfully, there is insurance for that as well. So that, in case of an unforeseen medical expense, you don't have to worry about, whether you have cash or whatever. You can just go ahead and get yourself treated, and the insurance pays for it in case you have a medical insurance. If you don't, then that's a different scenario altogether. As I said, both insurance and banking are critical pillars for an economy, and you also saw the value they provide us as individuals. But there are a few important things that I am sure all of you are aware, but it's worth taking note of again. One of which is banks don't invest your money. Meaning, whatever monies, of course, whatever monies in the system come through the banks, including your salary of late, this money is not invested or locked in an investment which might take long periods of time. Banks do not do that because, and so in some countries, banks are not allowed to do that. Why? A lot of reasons for it. Why? Because they don't want the monies to be stuck in a long term investment and thereby impact their liquidity. For example, if somebody goes to take a loan with the bank and the bank says, sorry, right now we don't have cash, so can you come back after 2 months? Or even worse, if you want to go and draw your money, which is with the bank, and they say, sorry, maybe come after 2 months, imagine the kind of hit the bank's credibility would take and how serious this is. So banks generally do not invest your money. They only loan it out to people. And of course, there are risks associated with loaning to people because there are defaulters, be it large corporations, individuals. So the bank has a system to ensure that the risk is minimized. They can't always guarantee 100% risk free lending. However, insurance companies do invest your money. I mean, that is their product. I mean, they do tell you that we take money from different sets of people, pool them together, invest it, and we share the returns. And so that they create a fund for you for retirement or for whatever other purpose that you're investing with them. So, again, when it comes to liquidity, your money with the bank, you can draw at any point in time, even if you have put it in the form of a fixed deposit for a certain period of time. Money with the insurance company, you can draw. I am sure you can draw, but there would be other associated charges, A and B. It would take some time and so on and so forth. So, you know the difference between the two in terms of keeping your money in either of these two different, what should I say, institutions. This is important categorization. I'm going to stop with this in this session. We're going to move forward and look at actual investments, what are the different options, how they work on the, in the ongoing sessions. Thank you for listening in to me. Thanks for your time. Stay safe, stay happy. Bye for now.